Well, for more on his market outlook, let's bring in Ryan Lewenza. He, of course, is at Turner Investments Raymond James. He's our featured guest of the morning. The economy, the North American economy this year, will we get away with it without a stiff recession, a steep recession?
We will definitely get away from any material recession. In the U.S., we will see it'll be close. So last year, U.S. economy grew at about 2.5. Defied expectations, grew at a much faster clip. This year, we're probably looking closer to like 1%. So not a ton of room there. But the key point there is that the labor market continues to hold in there. We're not seeing massive job losses that you typically see in recessions like in 2008. If we look to Canada, I'm a little less positive on our economy there. We may fall into a little bit of a statistical recession of 2 quarters. But again, I'm not expecting massive job losses. So it's going to be short and shallow if we see it here in Canada. So basically just a slowdown. But then we got the cuts. And then we see Bank of Canada going first and then the Federal Reserve probably in the spring. And so I think we kind of slow down a little bit. And then towards the tail end of this year, as these cuts started to come into place, then we'll start to see a kind of a floor of the economy and then a reacceleration into next year. But key point here is no major recession. We think more of a soft landing, particularly U.S.
You see rate cuts coming in the spring of this year.
Yeah, and the Bank of Canada is going to go first. Our economy is clearly decelerating at a faster clip. I do believe the Bank of Canada governor is, as he should be, is quite worried about housing. Okay, there's, I think of $200 billion of mortgages that are going to be reset over the next year. So they're going to be going from 2.5, 3.5 up to what, 4.5, 5.5. You're going to see mortgage amounts going up 1,000, 2,000 depending. And so that's going to weigh on consumer spending. And so I think the Bank of Canada goes first and then the Fed. Now, one concern I have for this year that could create a little bit of volatility is the divergence between what the Fed's actually going to cut and what the market's pricing. Right now, the bond market is pricing in 5 to 6 cuts, way too much.
Right.
And we're probably looking closer to 3. So maybe in February, March, May, Fed governor comes out and says, starts to send out the message, hey, we'll cut, but not in anywhere close to 5 or 6. Maybe you get a little bit of a pullback. But key point here is rates are going to come down. For the last 20 some odd months, it's been high inflation and high rates. Inflation is now coming down. Some cuts. How is that not stimulative to the economy and the stock market?
Okay, so what does the stock market do in 2024? You see the S&P 500 rallying.
I do. I think we're going to have a good year. And why is that? Because I see both of the drivers of stock prices helping. So let's back up. How does Royal Bank, how does Amazon or the S&P go up? One is corporate profits. Okay, so maybe Amazon has a great fourth quarter when coming up, and fourth quarter revenues are up 6%. Boom, stock rallies. Well, corporate profits for the S&P are going to be up. That's the chart we have up right now. So you can see, our viewers can see that earnings growth is going to be about 11.5%. That's consensus. Usually consensus is off. They're a little too bullish. But I think in this instance, I think 10 to 12% is positive. So earnings are going to be up. And then the second driver of stock prices is the old PE ratio. And we have been on this show before showing a really good chart that overlays interest rates with PE ratios. And there's a negative correlation. Real simple. When rates are going up, bad for the economy, bad for the stock market. Well, I think the U.S. 10-year is going to come down a little bit more. So maybe you get a little bit of PE expansion. I'm not calling for a lot. The U.S. market's fairly pricey at 19, but could it go to a 20 PE? Yeah. And when you get those years, when it's both earnings and PEs, S&P's not up 5, 6. The S&P's up double digits. I think it's going to keep going. But there's going to be volatility along the way. We got geopolitics. I'm very concerned about all the geopolitics right now. I mean, obviously, this Hamas-Israel conflict is expanding with now the Houthis and the U.S. getting involved. I want that to stop, right? We can't see that continue with maybe Iran getting in. I think this U.S. election is going to be a complete mess, very divisive. So it's not all roses. But when you and I talk later this year, I think our viewers are going to be happy with the markets and their portfolios.
Okay, last question. You've got some exposure to preferred shares. Why so?
Yeah, so we like preferred shares because just the dividends. We particularly like perhaps 2, 3, 4 years ago when interest rates were 0. right? So there you're getting a 4 or 5% yield. So we always will have some exposure. Sometimes we might have 10, sometimes we might have 15, but we like it for the cash flow. The key point here on preferred shares, we think they're going to have a pretty good recovery. Well, because they had a down year a couple of years ago. Well, why is that? History. So I'm a student of history. We were just talking about your son is enrolled in school and in history, right? We are history nerds here. So go back to history. There have been 4 years where the Canadian pref market has been down over the last 20 years. In every single instance, 4 for 4, the prefs then recovered up over the subsequent year or two. So right now you're getting 4 or 5% dividend yields, and I think we could have a 5, maybe even 10% appreciation over the next 12 to 18 months. So from a relatively lower risk investment, maybe we're looking at a 10, 15% total rate of return over the next year or two. And so we have those in our client, in our book, across our portfolio. But I am telling clients, if we get that call right, and it goes up to the kind of technical level I'm thinking, well, then maybe we pare it back. So you got to be a little bit tactical on prefs. They're a little bit volatile, but I think people will be surprised this year by the recovery of preferred